Welcome to the Deep Dive. We're here to dig into your sources, pull out those key insights, and help you really get a handle on the forces shaping our world. Today we're tackling a really big one, an economic roller coaster, you could say. Argentina's huge experiment with a hard peg currency board back in the 90s and early 2000s. Our plan is to walk through the incredible rise and, frankly, the spectacular collapse of Argentina's convertibility plan. We want to pull out the lessons here about currencies, about financial stability, and, that tricky relationship between economic policy and political reality. We're leaning heavily on a really insightful World Bank paper from 2003 called Living and Dying with Hard Pegs, The Rise and Fall of Argentina's Currency Board.
Yeah, and what's so striking, I think, is how relevant this story still feels. It's over 20 years ago now, but the dilemmas Argentina faced, they echo in so many emerging economies today, dealing with weak currencies, globalization. It's a powerful case study, a bit of a cautionary tale, sure, but also really shows the tightrope walk needed for economic stability and how even policies that look good on paper can sometimes sow the seeds of future problems.
Okay, let's set the scene. Late 1980s Argentina. It's pure economic chaos.
Oh, absolutely. We're talking hyperinflation like you wouldn't believe, money becoming worthless overnight, financial markets basically ground to a halt. People were desperate, truly desperate for some kind of anchor.
So April 1991, they roll out the convertibility plan. This wasn't just tinkering, this was radical stuff.
Totally radical. This wasn't just pegging the currency loosely. No, this was a strict legal framework. 1 peso equals 1 US dollar, period. And the key rule, the absolute linchpin, was that the central bank legally could not print pesos unless it had the hard US dollars in reserve to back them up. The idea was to create this point of no return, like Cortés burning his ships. A definitive break from the past instability, trying to force credibility where there was none.
And wow, did it seem to work at first. The paper calls it the good times.
Yeah.
And you can see why.
Definitely.
Right.
Financial activity just exploded. Remember, it had almost vanished before. Suddenly, bank deposits, loans, they just soared through the 90s.
And inflation, tamed.
Yeah.
Gone, almost, which then opened the door for all these other big reforms, didn't it?
Exactly. They could tackle the huge sovereign debt with the Brady Plan, bring in a proper VAT system, privatize state companies, reform pensions, deregulate finance. It was a massive overhaul, enabled by that initial stability.
Yeah, and the economy responded. GDP growth was, over 6% a year on average for most of the 90s? A remarkable turnaround.
It really was. But then came a major test, right? The 1995 Mexican tequila crisis. That sent shockwaves through Latin America.
How did Argentina cope?
Well, it was dicey. Deposits fell sharply, almost 20% in just a few weeks. That could have easily triggered a full meltdown.
But they didn't blink.
They doubled down. The authorities came out strong, reaffirmed convertibility, and actually accelerated financial sector reforms. They saw it as a chance to prove their commitment.
And those reforms were pretty extensive.
Very. The banking system consolidated. Big international banks came in by 2000. Foreign banks held something like 70% of all assets. It was seen as this crown jewel.
Well,
Capitalized lots of provisions, very liquid on paper.
they even had these fancy supervisory programs like BASIC.
Right, using market signals and enhanced official oversight. On the surface, it looked incredibly robust, a model even.
But you're saying there were cracks forming underneath all that polish.
Absolutely. While all this success was happening, something else was growing, almost unnoticed or perhaps willfully ignored: financial dollarization.
Meaning people just started using dollars more.
Yes, but in a specific way. It wasn't really the intention of the plan, but the market never fully shook off the fear of devaluation. And policymakers, well, they kind of avoided discouraging dollar use.
Right.
They worried that discouraging it would look like they didn't believe in the peg themselves, undermining the very credibility they were trying to build. It's a real paradox.
So even with this ironclad one-to-one peg, there was still this background hum of doubt, this peso problem, as the paper calls it.
Exactly. A small, maybe, but persistent perceived risk that the peso might break. And that perception drove behavior.
So people started saving in dollars, borrowing in dollars.
Precisely. Dollarization seeped into everything. Private debt, public debt. Crucially, loans to businesses that didn't earn dollars, like local services or mortgages. Even utility bills ended up priced in dollars.
Wow. So your local coffee shop's loan repayment suddenly depends on the Fed's interest rate policy.
Pretty much. And it's important to distinguish here that the paper makes this point well. There's asset substitution using the dollar to save for your time deposits. That became heavily dollarized. But then there's currency substitution, using dollars for everyday buying and selling. And actually, the peso remained the main player there for cash transactions, for checking accounts.
Okay, so people saved in dollars but spent in pesos, mostly. Why does that distinction matter?
It becomes really important later when you think about how they might have gotten out of the peg without complete chaos, but we'll get to that.
And this whole setup, the currency board making an exit seem unthinkable, it actually pushed the government to make it even harder to exit, like digging the hole deeper.
That's a good way to put it, the self-reinforcing dynamic, raising the stakes constantly, making the potential fall even more catastrophic.
So what happens when a country locked into this rigid system gets hit by shocks from the outside world?
Well, that's exactly what happened after 1998. Argentina got caught in what the paper calls this brutal currency growth debt trap, the CGD trap.
Okay, break that down. Currency.
The peso became massively overvalued. Why? Because it was tied to the US dollar, and the dollar was strengthening hugely against other world currencies at that time. Some estimates said the peso was 50% overvalued by 2000.
Making exports super expensive and imports dirt cheap. Bad news for local industry.
Terrible news, which leads to the second part, growth. The economy just slammed into reverse. A deep, painful recession took hold, GDP shrinking, unemployment soaring. This was worsened by capital suddenly fleeing emerging markets, especially after Brazil devalued its currency in '99, making Argentina look even more expensive.
And the third part, debt.
Debt. With the economy shrinking and the currency overvalued, servicing the government's debt became a nightmare. Sovereign debt climbed rapidly from below 40% of GDP towards over 50% by 2000, and the interest rates they had to pay skyrocketing, a classic death spiral.
So trapped, how do they try to get out?
Well, the paper describes their efforts as half-blind, which feels about right. They tried hiking taxes in 2000 to fix the budget deficit, but it just deepened the recession and didn't restore confidence.
Then Cavallo came back, the original architect of the plan.
Right, in April 2001. And he tried some really unconventional things, sort of tweaking the peg without officially breaking it, an import tax, export subsidies, talking about maybe pegging to a basket of currencies down the line.
Did that help?
No, it just made things worse. It created more uncertainty about the future of convertibility. People started thinking, okay, the end is near. And crucially, behind the scenes, the core of convertibility started to unravel, that heavy legal armor. They began dismantling it themselves.
Wow.
The central bank charter was changed. That fundamental rule, no printing pesos without dollar reserves, effectively gone. They created loopholes allowing the central bank to inject liquidity by buying government bonds.
So the very foundation was cracking.
Exactly. The point of no return was being bypassed from within.
And this next part is where it gets really alarming, isn't it? The government running out of options.
Completely. External markets shut them off. No one would lend them money. So where did they turn?
Their own banking system.
Yes. They started basically forcing banks, pension funds, to buy government debt, using moral suasion, which is a nice way of saying immense pressure.
So the banks, which looked so strong on paper, suddenly found their assets stuffed with government IOUs that were looking increasingly shaky.
Precisely. Bank exposure to the public sector just exploded from under 10% of assets in the mid-90s to over 20% by late 2001. This created this deadly embrace. The fate of the government, the banks, and the currency were now inextricably linked. One fails, they all fail.
And that's the trigger for the final implosion.
It's the final link in the chain. This toxic mix, overvaluation, recession, unsustainable debt, and now banks loaded with risky government paper, it just shattered confidence completely. By late 2001, you get a massive, unstoppable run on the banks.
People rushing to pull their money out.
All their money, pesos, dollars, everything, which led to the infamous Corralito.
The limits on cash withdrawals?
Yeah, a desperate move to stop the hemorrhaging. But it paralyzed the payment system. Imagine not being able to access your own bank account. Chaos.
And then, total meltdown.
Complete meltdown. Riots on the streets, presidents resigning one after another, 5 in less than 2 weeks. A massive sovereign debt default. And finally, in January 2002, the official abandonment of the currency board.
And then that final act, the asymmetric pacification.
Just devastating. Forcing dollar loans to be repaid in pesos at 1-to-1, but converting dollar deposits at 1.4 pesos per dollar. It wiped out savings, destroyed contracts, an unbelievable breach of property rights. The government basically saying, your dollar savings, they're not really yours anymore.
Let's dig into that bank run a bit more. Was it just people panicking about weak banks, or something bigger?
It was definitely bigger. The data shows it was systemic. It hit all types of banks, local private ones, the big foreign banks, even public banks. It wasn't just a flight to quality.
So not just picking off the weakest.
No. It started maybe as a shift from peso deposits to dollar deposits within the banks, but very quickly it became a run out of the banking system altogether. People wanted their cash, dollars preferably, out. Full stop.
That suggests the problem wasn't just individual bank management, but the entire system's credibility.
Exactly. The analysis in the paper shows that things like a bank's capital or liquidity became much less important in explaining deposit outflows during the peak crisis. What mattered most?
Currency risk.
Country risk.
Primarily, yes. For peso deposits, it was the fear of devaluation currency risk. For dollar deposits, it was driven more by overall country risk, the fear the whole system, including the government, would collapse, maybe even confiscate dollar holdings. It started as a currency crisis that morphed into a total financial system crisis.
Okay, so looking back at this whole dramatic arc from success to utter disaster, what are the big lessons you can draw from this? The paper highlights quite a few critical ones. I think the first one is about the limits of these hard pegs as commitment devices. They can help stabilize things initially, like we saw in Argentina, boost finance by offering that seemingly stable dollar anchor. But they don't magically fix underlying problems. They don't automatically create fiscal discipline or make painful wage adjustments easier. Argentina's politics just made those kinds of nominal cuts, cutting spending, cutting wages in dollar terms, incredibly difficult.
So that whole idea of the peg being a monetary straitjacket that would force the government to be responsible, that didn't really pan out.
It proved pretty naive, yeah. When push came to shove and the external funding dried up, did the government tighten its belt? No. It found ways around the rules. It started printing those quasi-monies, the LECOPs, the patacones.
Basically, IOUs issued by provinces or the federal government?
Exactly. Money printing by another name. It was a clear sign that the rigid monetary framework was fundamentally inconsistent with the country's inability or unwillingness to make those tough fiscal and wage adjustments.
And that connects back to the banks holding government debt, right? A prudential failure.
Absolutely. Letting the banking system become so exposed to the government's own default risk was a huge vulnerability. A fiscal crisis instantly becomes a banking crisis. They tried to address it too late.
What about liquidity? The banks were supposedly highly liquid.
They were, on paper. They had high liquidity requirements. And that did help initially. It cushioned the blow. But the paper points out once the run really got going, especially the run on time deposits, that liquidity got chewed up incredibly fast.
So just having a big pool of liquidity wasn't enough to save the payment system, the day-to-day transactions.
Apparently not. It suggests maybe you need more specific rules to protect transactional deposits, the money people use for everyday life, to keep that part working even if there's a run on savings.
And the other ticking time bomb you mentioned, bad loans hidden by the overvalued currency.
Right. The latent NPLs, non-performing loans. When your currency is significantly overvalued, your local businesses, the non-tradable sector, they struggle to compete. Their incomes stagnate or fall in real terms, making it harder and harder to repay loans, especially dollar loans.
Even if the loans look fine on the surface for a while.
Exactly. The peg masked the underlying weakness. The painful adjustment, the deflation needed to become competitive again, was happening slowly and crushingly. The paper argues they needed much tougher rules for classifying and provisioning against loans to this vulnerable sector much earlier.
Okay, this brings us to the really tough question. Could they have exited differently? Avoided the meltdown? The paper looks at alternatives.
Yeah, with the benefit of hindsight, of course. Option 1.
Okay.
Just float the peso.
Let it find its own level.
Right. Problem. It likely would have caused an immediate massive devaluation, a huge currency run, mass bankruptcies for anyone with dollar debts, and probably instant bank failures, politically, economically, seen as totally catastrophic at the time.
Okay. Option 2. Stock pacification come float. Basically what they ended up doing.
Yes, and the paper argues this was probably the worst possible choice. Why? Because it involved that massive violation of contracts, the murdering money as a store of value. It actively fueled the bank run and created this deep, long-lasting distrust in the financial system. Required the deposit freeze just to stop total collapse.
Not ideal. Option 3. Formal dollarization. Just adopt the US dollar completely.
This had some appeal. It would have respected existing dollar contracts, possibly calmed the bank run, maybe boosted confidence like it seemed to in Ecuador around that time.
Yeah.
But it wouldn't have solved the fundamental problems. The peso's overvaluation, the lack of fiscal discipline. The economy would still have faced a long, grinding, deflationary adjustment just under a dollar regime instead of a collapsing peg.
Which brings us to the fourth option, the one the authors seem to favor. Stock dollarization cum pacification at the margin. Bit of a mouthful.
It is, but the idea is quite clever, actually. It's a hybrid approach. Step 1. Dollarize all existing financial contracts, loans, deposits, acknowledge the reality that the dollar was the trusted store of value, and stop the panic by guaranteeing those contracts.
Okay, stabilize the existing stock of wealth. Then what?
Then, for the flow for future transactions, wages, new contracts, you consolidate the old pesos and those quasi-monies into a new national currency. And you let that new currency float against the dollar.
Ah, so you respect past dollar promises but create flexibility for the future.
Exactly. You avoid the property rights destruction of pacification. You give the economy that crucial margin for nominal adjustment, wages, prices, government spending could adjust in the new floating currency terms, easing the deflationary pressure.
And it leverages that point you made earlier that people saved in dollars but still used pesos for transactions.
Precisely. It acknowledges the dollar's role as a store of value by dollarizing existing contracts, while trying to preserve a national currency for transactions, hopefully allowing for a less painful adjustment overall.
Fascinating alternative. So, wrapping this up, what's the big takeaway for you, the listener, from this whole dramatic story?
Well, it's a powerful reminder, isn't it? Just letting your currency float isn't a magic bullet. If your financial system is weak or shallow, people won't save or lend long-term in a currency they don't trust.
But the flip side, a rigid hard peg isn't a cure-all either. Not if you don't have the fiscal discipline and the nominal flexibility in wages, in spending, to actually live within its constraint.
Right. The core challenge, especially for countries perceived as having weak currencies, is still finding that sweet spot. How do you build a strong, trusted link between your money and your financial system, one that can withstand shocks?
And Argentina's experience makes that challenge look even harder, doesn't it, given their history?
Oh, absolutely. After decades of inflation chipping away at trust, and then the convertibility collapse and that forced pacification, basically, the state breaking its promise on dollar savings, rebuilding faith in any locally issued peso as a reliable store of value, that's a monumental task. The scars are incredibly deep.
Which leads us to a final thought for you to consider. What is the realistic path forward for a country like Argentina? Is it decades of painstaking work, building institutions, trying to convince people, generation after generation, to trust a peso-based financial system again?
Or is the reality more likely a kind of permanent bimonetary system where, okay, the peso works for daily stuff, for paying salaries and buying groceries, but when it comes to serious savings, long-term contracts, people just instinctively reach for the dollar despite all the risks and past trauma?
It suggests the problem isn't just choosing the right exchange rate regime. It's about the deep foundations, the institutions, the political will, and ultimately that fragile, hard-won thing called trust.